Good morning. Welcome to this Bell Direct webinar on direct margin lending this morning. It's on quite a focus on positive gearing, and it will be presented by Rowan Fell, the Director of Bell Capital. The presentation, it will go for about 20 minutes, and then we'll have 10 to 15 minutes at the end for questions and answers. So if you think of any questions when Rowan's presenting, there's a little box down the bottom called chat. And if you just type in your questions there, Rowan will attempt to answer as many questions as possible at the conclusion of the presentation. So I'll hand it over to Rowan.
Okay, thank you very much, Michael. So we might just start with covering what we're going to talk about today. Just getting my screen set up. Here we go. So we're going to cover, these are the topics we're going to cover broadly. The slides won't match exactly these themes, but this is what we're going to cover. So firstly, I'll just talk a little bit about myself. Then I'm going to explain the concepts of positive and negative gearing. Then talk a little bit about, why you should consider positive gearing, the sort of the risks and the benefits. And then if you want to have a look at doing something, then how to make a start in doing that. So by way of introduction, I'm the Director of Bell Capital. We're one of the subsidiaries of the Bell Financial Group, and we're a sister company of Bell Direct, and we provide the direct margin lending product. Personally, I've been involved in running margin lending businesses since 1995 and have built a number of different margin lending businesses. So I've got a significant amount of experience in margin lending through a number of different market cycles. I'm going to assume that this audience is new to margin lending, and I've been chatting to Michael about doing some future webinars where we might also have some other introductory webinars and possibly introduce some more difficult concepts as well. I just want to sort of quickly talk about the economic state of play. I mean, the current circumstances that we're going through following the global financial crisis are actually quite unusual. We have historically very low interest rates. We've got the RBA cash rate at 2.5%, and possibility that may go even lower. We've got still on selected shares, particularly some of the very good major industrial shares and the sort of major banks, we've got a very high level of fully franked dividends. And the outlook, the economic outlook and the outlook for equity markets is for low but stable growth. If we go back 5 to 10 years, people were thinking they might get 10 to 12% capital growth in some years, maybe even 25%. But we'd be suggesting that when you're setting your expectations and planning how to manage your portfolio at the moment, that if you're looking at major companies such as some of the banks and major retailers, you'd be looking at expectations of, say, 5% capital growth and reliable dividends. It's worth noting that corporate balance sheets in Australia and more generally worldwide are in excellent shape at the moment. So moving on to talking a bit about explaining the difference between positive and negative gearing. We're all very familiar with the idea of negative gearing over investment property. The general idea is that you buy a property, you might put down a 20% deposit. The rent won't cover the cost of outgoings, which includes interest on the mortgage and maintenance of the property, etc. But your hope is that the value of the property over time will increase much more than the cost of interest and other outgoings. And in the meantime, you'll get a tax deduction for the negative income that you receive. So in any gearing proposal, the first step is to buy an income-producing asset. And as I've said, with negative gearing, your taxable income will be less than the cost of interest, and so you're actually making a loss for tax purposes. It's worth saying that we're not in a position to provide you with any tax advice, so this is just general information. Obviously, negative gearing only makes sense where you've got the expectation of making a capital gain over time, and that you've got other income that you can use to shelter that tax loss that you're making. And typically, you also expect that the level of income will rise over time. The real risks with a negative gearing strategy, and perhaps a few people may have experienced that in the last 2 or 3 years, is that you don't get the capital growth that you're expecting. I mean, if we look at certain parts of the property market, they've been quite flat for the last 3 years, although more recently sort of key properties have been going up. But also you may get no income growth, interest rates might go up when you least expect it, and especially in less mainstream properties, you can have issues where you're unable to sell the asset when you need to. So how is positive gearing different? Well, simply we're looking at income from the asset that you buy, and that income exceeds the cost of borrowing, and that you're generally generating a taxable profit. Quite amazing when I've sort of talked about this concept to clients over the years, they're saying, but hang on, the whole idea of this is that I make a loss. I said, well, hang on, doesn't it make a lot more sense if you're actually able to set up a business that makes a small profit? So that's part of the idea for positive gearing. So with shares, which is obviously the key asset class that we're looking at in this case, you include the franking credit as part of your taxable income. So that franking credit won't actually be received in cash when you receive the dividend, but you get the impact of it when you lodge your tax return, because it'll come through by reducing the amount of tax you pay. So let's just think about a share that pays a 6% fully franked yield at the moment. So that's on a major company, that's a high dividend yield, but some of the major banks are currently yielding on a forecast basis approximately that level. So when you include the franking credit, we talk about that as grossing up to a level of 8.57%. So that's taking the 6% cash dividend that you get and adding on the value of the franking credit, which will gross it up to 8.5%. So from a tax point of view, it's the 8.57% that actually goes into your tax return as taxable income. So looking at now at the sort of cost of interest, I mean, the headline rate currently for direct margin lending is 7.8% per annum for loans up to 100,000, but for loans sort of over $500,000 or over $1 million, which is obviously a large loan, that rate can be quite substantially discounted. But this sort of income equation also depends on the level of gearing that we're looking at. So I'm going to talk now a little bit about how gearing works. So on this slide, I think this is quite a good way of motivating the idea of gearing. We've obviously got an old-fashioned speedometer here. If you think about the number on the dial there is perhaps the amount that you might have borrowed to support a portfolio of $100,000. So the dial's currently set at 50. So if you've borrowed $50,000 to support a portfolio of $100,000, we would say that's a 50% level of gearing. And the comment that I've made there is that at 50, things are kind of under control. You're in a good position to adjust to deal with any sort of bumps in the road, if you like. You can obviously make the comparisons to the share market. So 50% is generally considered to be a sort of a moderate level of gearing. If you look at sort of slower speeds or slower or lower levels of gearing, say around the 20 or 30%, you obviously wouldn't want to fall asleep at the wheel, but it's much easier to cope with all outcomes. And then once we get to higher speeds, higher levels of gearing, say around the sort of 70, 75%, which is typically the maximum that you can borrow against major shares in the Australian market, things happen much more quickly. So that if you have sharp falls in the share market or sharp rises in the share market, the leverage impact on your portfolio is much greater. So one of the things you need to consider is, basically how quickly are you prepared to drive your risk in margin lending. And we would generally suggest that if you're new to margin lending, that you keep your speeds sort of well below that 50 level. I'll just move on now. So just fleshing that out a little bit more, let's assume that we want to build a portfolio worth $100,000. So if you put up $75,000 and borrow $25,000, we would say you're 25% geared, and that's a low level of gearing. If you put up $50,000 and borrow $50,000, then you're 50% geared, and we would generally say that's sort of a moderate level of gearing. You're able to cope with sort of minor changes in the market quite easily. And if you put up $25,000 and borrow $75,000, which is probably typical of what you do in a property, we would say that's a relatively highly geared portfolio. Sort of the maths in margin lending is actually quite complex for many people, but I always find it's much easier to think about it if you think about it in terms of the size of the portfolio you're building rather than the amount that of capital that you start with. And the amount that you put up is effectively the deposit, so it's a bit like deploying a deposit on a home. So in the highly geared case, you put up $25,000, that's your deposit, and we actually call that the margin. So I'll just move on to the next slide now. So let's just look at how, when we combine the ideas of gearing and income together. So this is a very simplified example just to illustrate the points, and I'm using the same figures that we used before. So let's say that we have an existing portfolio of $50,000. If we look at the column under ungeared in here. So we've got a portfolio worth $50,000. We don't have a loan. We're receiving a 6% fully franked dividend that grosses up to 8.57%. So that generates a grossed up dividend of $4,285. There's obviously no interest. So our taxable income is $4,285. And if we had that sort of modest capital gain expectation, the level of capital gain that we might expect on a sort of an annual basis over sort of averaged over a number of years might be of the order of sort of $2,500. If we geared that portfolio 50%, so you could actually use your existing $50,000 share portfolio as initial collateral to a margin lending facility and then add another $50,000 worth of debt, we now have a $100,000 loan, and we borrow $50,000 of that. Now the dividend on the whole $100,000 is obviously double what it was before, so that's the $8,570. We now have an interest bill of at 7.8 on the 50,000, which is 3,900, and so the net taxable income now is 4,670, which is just the difference between the 8,570 and the 3,900. So we've had a sort of roughly a 10% increase in the amount of taxable income that we've received on our capital of $50,000, which is in itself a good but modest result. But possibly the key thing is that the expectation of our capital gain is now double. So we're now sort of potentially on our 5% capital gain expectation would be earning a capital profit of $5,000, an unrealised capital gain of $5,000. It's worth saying, because of the ideas of sort of negative gearing and things, many people approach margin lending with tax as the first thing in their mind, but we think that when you're looking at a margin lending facility, your primary driver should be the profit that you earn through income and potential capital gains, sort of not the tax deduction. So when we look at the dividend difference there through gearing, it is relatively modest. But one of the things to keep in mind, and I've given you an example on the bottom of this slide, is that dividends tend to grow over time. And this example is probably quite extreme, but if we go back to 1992, CBA paid a 40-cent fully franked dividend in 1992, and this year, 2013, they're paying a dividend of $3.64. So that's a very substantial gain in the amount of dividend, admittedly over a 20-year period. But banks, for example, have tended to increase the amount of dividends they pay in pretty well every year of the last 20 or so years. We obviously had a bit of a wrinkle through the global financial crisis, but it is a pattern with the banks that they tend to increase the amount of dividends they pay. So, on the face of it, this looks like a reasonably good strategy, but there are obviously risks involved. You don't get anything for nothing in this modern world. So let's just go through the risks. So obviously the first risk is that interest rates rise unexpectedly. We think that risk is relatively low over the next 2 to 3 years, but it's something that you need to keep in mind. There is obviously a risk that dividends aren't paid, and even in major companies there can be a period where they tend to not grow their dividends, or their dividends might actually be slightly reduced. So especially if you're going to slightly smaller companies, there is always a strong risk that dividends may not be paid and that you will need the resources to meet interest without having the dividend flow. It's obviously also a risk with this strategy that the capital growth expectation that you may have might not be met, and that's obviously a key risk. Share prices can always fall unexpectedly, and you may be required to top up your facility by meeting a margin call, and that's a complex topic in itself, but at levels of gearing sort of below 50%, the chance that you would receive a margin call is fairly low. Obviously with things, with world events happening unexpectedly, for example, what we're seeing in Syria just recently, prices of shares can actually move quite quickly and unexpectedly, and so it's important to always keep that in mind. Often when we look at sort of positive gearing strategies, people look through the yields that are available on shares in the market and find something that has a yield of, say, 11% fully franked. That should always set off a warning bell in your mind. It's unlikely that a dividend level of that level is sustainable for companies. And the reason why the dividend yield is so high is typically because the market price of the share has fallen, because the market generally, the analysts in all the institutions and all of the players in the market are concerned about the outlook for that company and therefore have reduced its share price, and the result of that is that its yield's relatively high. So typically that kind of very high yield can't be sustained for a long period of time. The other risk in managing this sort of strategy is that cash flow that you get from the dividend doesn't actually match the timing of the interest that you pay, and you've also got to remember that you don't get the benefit of the franking credit until you've actually lodged your tax, and that comes through a reduction in the amount of tax paid. So it's important that you're able to manage cash flows through this strategy. And the way to moderate all of these risks really is to only gear initially, at least, at a very sensible level, and we'll talk about that a bit more in a moment. So let's look at if you wanted to make a start with this strategy. Firstly, it's relatively easy to open a direct margin loan online. You can you're well guided through a dialogue on the screen, and the client service team can potentially support you as well doing that. So once you've completed the documentation online, we also need to be provided with some basic credit information, and that's actually a requirement of the corporations law, that we are actually able to confirm that you've got sufficient income and assets to consider taking up a margin lending facility. Once the facility is set up, we don't actually require you to use it. You can actually use your margin lending facility and actually trade in credit, just as you would normally in a stockbroking facility, and only when the opportunity arises that you actually want to borrow, that you can then actually draw down the facility. So it's quite feasible to run your margin lending facility for quite some time in credit, just use it like an ordinary stockbroking account, and then when you see the opportunity to borrow, you can then borrow. You also don't have to keep the loan drawn. You may see an opportunity to buy a major company and pick up, say, the next 2 dividends with the intention of then, disposing of those shares following the receipt of the 2 dividends. Also, when you are ready to borrow, I think the best way to start in margin lending is that you start small, so that you become comfortable with the concepts in margin lending, and then just gradually increase the size of your portfolio once you are confident that you understand all of the risks. So that's it from me for today. So I'm happy now to hand over to questions. Thanks, Michael.
Thanks for that, Rowan. We've got a couple of questions that have come through. The first one was, are you able to take out a margin loan against any stock or only stocks in the ASX 200?
You can't take out a margin loan against any stock. If you look on the website, on the Bell Direct website, you'll find there's an approved list. I think it's in the Trade Now section, if I'm not mistaken. And typically the major industrial companies will have an LVR of 70%. A few selected companies, such as the major banks and Woolworths, will have LVRs of 75%. And then as we go down to smaller companies, they may have LVRs as low as 40. There are some companies in the ASX 200 that we don't lend against because we consider them too risky for our book. And there are a lot of companies outside the ASX 200 that we will also lend against because even though they're smaller companies, they have a good sustainable business model. We tend not to lend against exploration companies or biotech companies because we're really looking at companies that have a sort of sustainable business model as a key criteria for lending.
Okay, and our second question that we've got is, what's the minimum portfolio size you should have before you consider taking out a margin loan?
Well, that's a good question. We've actually, a lot of margin lenders have a minimum loan size of 20,000, for example, or 50,000. My view has always been that if you're going to take up the time to actually set up a facility, we're happy to support a facility with no minimum. So if you only had $5,000, which is actually still quite a lot of money, then we're happy to actually lend you $5,000 to buy $10,000 worth of shares. And that can actually be quite a good place for some people to start. But, in general, I would think a portfolio of $50,000 is probably a good place to start, but there's no reason why you can't start smaller.
Okay, and I guess following up from that question, there's one more, which is our last one. Do the rates on the margin loan vary depending on the amount of money that you're borrowing?
They absolutely do. Basically, I think the rates are on the website, but we reduce the amounts progressively as the loans get larger. So the headline rate applies up to $100,000, then it drops down by, I think, 0.2% up to $250,000. And then by the time you're over $1 million, they've dropped by 0.9%. So
okay.
Our rates are automatically tiered and apply as your loan gets larger automatically.
Okay. All right. Well, thanks very much for the presentation and for answering those questions, Rowan. That's all the questions we've got thus far, so we might wrap it up there. Thanks everyone for attending today, and we'll be sending out a link with the recording, so if you need any clarification on anything that Rowan's presented, feel free to watch it again. Thanks for joining us, and have a good morning.
Okay, thank you.